right? So you know discounting factor, it is either PV or PV4. The rate that you're using is the discounting rate. What happens is that when you are changing or converting future cash flows to the current ones or present cash flows, then we call it discounting. You are converting what you could have gotten in the future to its equivalent today, that is discounting. When you are trying to take what you think you can get now, you are making it into future, you're moving from today into future, it is called compounding. So discounting is the opposite of compounding. So with compounding, you are saying, if I invest this much today, for example, you have amount should be equal to the principal into 1 plus R, right? So that means this is the amount that you're placing today. The total that you're going to get in the future is what you're going to call the amount. But now for compounding, and this one you can have N here, depending on the number of years. For compounding, it is now A is equal to P. This is now the P. So P is equal to the amount. This is P for the present. So P, which is the present value, is equal to the amount that you need to get every month times the discounting factor, which can be PV or PV4. So it is basically the same as this. And of course, you know the formula for PV4. If it is PV4 or PV, you know the formula. We are having 1 plus R negative N. So this one is negative because we are coming from the future to the present. This one is positive. We are from present to the future. Now, the rate that we're using here or here, that is what we call discounting rate. That rate could be the rate of return on investment. That rate can be the interest rate. I said at the beginning when we are starting, I said that whatever can be an income to you can be a cost to someone else. So it is income to you, it is a cost to someone else. That is how the business is, right? Ukienda kununua nguo leo, the person who is selling, it is income, but to you, it is a cost. The same with banks. When they give you loan, that is the interest rate on loans are income to them, but to you, it is an expense or cost. That rate, for example, the rate of interest that you're talking about can be having some elements of risk. The element of risk are because probably the inflation or the exchange rates in the market. Now, that risk element, you can actually adjust it. You adjust that risk element in it. So we call it risk adjusted. This risk adjusted. You adjust the discount rates with the risk elements in it, so that you recognize the expected risk on that kind of rate of return. You incorporate the risk on that kind of rate of return. I want you to write that this one, which we call RAD, I want you to say that this is the adjusted cost of capital that mirrors the level of risk of individual project. Or you say, this is the adjusted cost of capital. This is the adjusted cost of capital that mirrors the risk level of individual project. So we are taking risk into consideration. And in this case, we are looking at the specific risk of that individual project. We are taking risk into consideration, but the risk is for that individual project. I will repeat. I'm saying that This is the adjusted cost of capital. Adjusted cost of capital that mirrors the risk level of individual project. So we take into consideration the risk level of individual project. Here's the adjusted cost of capital that mirrors the risk level of individual projects. So that we say, normally, as we proceed, we shall be able to look at in topic 2, the cost of capital, or in topic 3, the cost of capital. So when you are looking at the cost of capital, we are saying that in the market where you are doing business, like in capital market, that is where we do exchange of loans. We sell bonds and long-term bonds and debentures. So when you go to the market, there is a risk in the market on that particular project, and then there is a risk that prevails in the whole market. Are we together? Risk on the project and risk on the whole market. That risk in the whole industry or the whole business that you cannot reduce. Similarly, we are saying that even though there is a risk, there should be a minimum return that you can get. However kidogo, kuna kitu lazima upate kwa biashara. However kidogo, lazima upate kitu. Now, there are projects that are risk-free or investments that are risk-free. Like, for example, the treasury bills and bonds. Those returns are always risk-free. Are we together? Don't draw this, but you can do it at the back of your book. So I want you to look at this and have this one as a return. When you are investing, you expect some return. So let's have that as a return. And then we have this as risk. You know, and I also know that in business, the higher the risk, the higher the return. When you take a higher risk, you can also get higher return. Like somebody that I know sometimes back in 2019, alikuwa involved in drug dealing, wash. You know, wash. Yes. Wash. You can do it within 2 weeks, you're a millionaire. You can get 1 million within, even 9 million within 2 weeks. Lakini ukipatikana, unawekwa ndani. Of course, yeah, aliwekwa ndani. Ako ndani. Now, and I warned him. He said that he wants a quicker cash. He wanted money very fast. So it comes with the challenges. Right? Now, see your wash ya mwili. Hii ni wash. You take ill-gotten money, dirty money, or money that you get from a wrong source or illegal source. You clean it so that you can be able to now to use it. Oh, so you're saying mwalimu, not mwili, sawa. So that is what they're doing. So they can sell drugs. Wash also happen with the drug trafficking or human trafficking. It could be maybe a terrorism financing. There are a lot of things. We call them money laundering. These people make money. Some people are also doing it through fraud. You just steal from a company, but because you have a lot of money, you will be questioned. They go and claim it. That's what they do, washers. Lakini ukipatikana, the risk is very high. You can be arrested and you get in prison for even 30 years or lifetime. Some countries, like where that guy alishikwa nje, China, in 2019. That guy, kuna rumors that he was even crushed. Kama alikasha, wale crash ujama, kama alinyongwa. So it is a very risky business. Of course, if you succeed, you'll be driving V8 in the next 2 weeks. You'll be having some floods in Nairobi here. So what you're saying is that in any business or in life, if you take a higher risk and you manage to succeed, the risk will be higher, the profit will also be higher or return. That is what happens in the business. Those who are not risk takers, they will not take risk and they will keep on getting small money forever or for a long period of time. But those who are risk takers, they will be able to get only one deal and they are done. So the same way, we are saying that if this one is the risk level for business and this is the expected return, we expect you that your investment will proceed. The risk level here could be 20, then 30 here, then here maybe 40, right? 40. So you can see the risk level increases. And so we expect your return to also increase because the graph of investment should be like that. So your return should also increase. As you take more risk, the return. Let's say that you are here. What is the expected return? It's quite high. So the higher the return, the higher the risk, the higher the return. Or the higher the return, the higher the risk. But we have those people like me who will not want to take much risk. They are risk averse. They will come and invest in those projects that they are very sure they cannot lose money. Or, of course, I've lost money in businesses, like millions of money I've lost in businesses. And I know you can also try and lose like me. But we are saying that we have people who are very risk averse. They will not try and lose money. With them, they will want to invest in stock, or we call them securities that are safe. Those investments that we do in capital market or stock exchange, we call them securities or shares or stocks. There are those that are very riskless. They are risk-free. Those risk-free investments are like bonds and bills. Do we know bonds? These are government. They are for government. When government wants money, they always issue certificates for bonds or bills. People buy from them and then give them money so that you become a debt holder. That is what happened with Eurobond. Who can tell me what Eurobond means? Waziri, wewe usiseme, wacha kina Henry, Ruth, and the rest. Tell me what Eurobond is. You see now, bonds and bills. Bonds are for long term, bills are for short term. Then there's something we call Eurobond. What is Eurobond? What is Eurobond? Mary, Topista, what is Eurobond? What is Eurobond? Eurobond. Did I mute? Ask Chat GPT. Okay. Don't Google. Let somebody else try. Somebody who has not Googled. So when you take,
it was in the news, yeah, Kenya Eurobond.
Same again.
I was saying news. It was in the news that the president has succeeded to push forward the Eurobond, which was supposed to mature.
Yes.
It's the loan that is taken in another currency, other than that of the countries. Like the problem we have now is because our debts, it's a debt. I mean, because our debts are in dollars, and that is why we are having problems.
Yes. So that is what we call Eurobond. When you take a loan in another currency, the currency that is not yours and probably is not from the country where you are trading, it is Eurobond. So it doesn't mean that it's a bond that is in euros. No, it can be in dollar, but it is a different currency from your country and from a different currency and from a different currency other than that where you are trading. Now, what basically happens is that when government wants money, they can get those bonds, or we call them debentures or bills from people and from institutions or other countries. Those ones we consider to be safe because the government cannot die. You know, government is like a country. The country cannot die, the whole country. So at the end of the day, they will pay it. It might take time, but they will pay it. Tunaelewana? They can only come and discuss and negotiate. Like now, the Eurobond that is there, Ruto can go and negotiate so that we push. We don't pay if it is maturing today, we push. Now, that kind of bonds, government bonds or bills, we say that they are risk-free because, and risk-free, we write like that, RM. Why? Because they cannot fail to pay. If it is a country, if it is a company, the company can actually go down. If it is a person, that person can die. But the government cannot. The president will die, or the president can die, a new president can be appointed. Right? So it is continuing thing or institution. So it is risk-free. So what we are saying is that as an investor, when you are investing, your main aim is first to start with the minimum possible. When you look at the risk-free, for example, risk-free, it is always the lowest return that an investor should get, but it has the lowest risk. So at this point, you first start with the investment that is risk-free, or not even lowest risk, but risk-free. So that means that if you are an investor and you decided to choose investment in projects that are risk-free or very low risk, then one that you can start with as part of your portfolio. Portfolio are just group of assets. So for you to spread the risk, you buy assets from different companies, and then we call them portfolio. So portfolios are group of assets. So those portfolio, you can buy we can buy shares from KCB, you buy from maybe Kengen, you buy Kenya Airways, KQ, right? Kenya Airways, you buy from somewhere else, or maybe Safaricom, unachukua kidogo kidogo. Kwa nini? So that if KCB goes down, umebaki na kitu. Ama if you make loss, unabaki na kitu. So you spread the risk by having so many assets or stocks or shares in different companies. Now, when you put these ones together, we call them portfolio. And we shall do this in our topic number 2. When you put them together, we call them portfolios. So portfolios are a group of assets that are put together by an investor. Now, an investor might want to choose and pick different portfolios, but for him to be very sure of the return, he can pick one of the risk-free assets so that whatever may come is actually safe, at least in one investment. So let's say that this one is risk-free. So if it is risk-free, then it means that it does not have any risk. You can't say imefika hapa, no. The risk is just flat. It's just flat. So that investment will start from here. So that means that the risk level has not moved, has not left this point. It has not started moving. It is just on this line, but the return is increasing. The return increases up to here, but the risk is constant. Therefore, it has a straight line, zero risk. So this kind of investment is the minimum that you want to get. Any investor want to get. So kama wewe ni investor mchoyo, then now from here, you want something more than just this one. So let's say that this one is 10, that is a return. But if you're a greedy investor like me, you want to get more than this. Now you want to look for something more than 10. It means that the minimum you can start with is 10 plus the one that you're now looking for. That one that you're looking for is now risky. So that means that the risk-free is up to 10. But now when you go up, this part is now risky. Any investment now above this is the risky investment. So that therefore means, if I have a portfolio, then I can have a portfolio where part of the investments are risk-free, and now the risky ones start from here now from 0 going forward. So that I have a graph that looks like that. which start from here. This portion is the one that led to the risky investment. Right? This gradient is for the risky investment. This one is risk-free. Therefore, when you're looking at the cost of any investment, and I say that the cost is the same as return, so when you're looking at the return of an investment, that return, if it is 12, for example, if it is 12 or 15, it means that the first 10 were risk-free, and then the other 5 is now risky. Therefore, I have a total of 15, of which the first 10 does not have any risk. The next 5 are having some risk, because I ensured that at least I had a minimum return of 10 when things go bad. Now, as an investor, we are now concerned with the risk of the risk investment. We are not concerned with the risk here because it is zero risk. The first 10 we are assured of. We are now concerned with this. So my return on investment, if it is 15%, then I should be worried on how to adjust the risk on this element. Risk-adjusted discount rate on this particular element. This one, I don't adjust risk because we don't have risk at all. And so my return will be a total of these two. But I'll be adjusting risk on the risky part. The riskless or risk-free part is not adjusted, because it does not bear any risk at all. Are we together up to there? Topista, kuna kitu umeelewa? Assuming that you are a finance manager or an investment analyst, and then unajaribu kuangalia hiyo investment portfolio. Unaambia huyu mtu, nikiangalia hii portfolio kila kitu ni risky. Can you diversify so that you have some that are not risky and some that are risky, so that even if you are making losses, but there's something that you are very sure that you cannot lose, and that is the risk-free investment, so that you start from here. And so the same thing happens. Now in the market, if I want to invest in a risky investment, my perimeter or determinant will be the risk-free. I need to get the premium. This one is the premium. The one on top here is the premium. It is the additional return that I'm getting as a result of risk that I'm taking. Otherwise, this one is guaranteed. So that my loan in the market, and that is why the government through central bank keeps on changing the interest rate on loans. Unaambiwa the base lending rate is now 13%. If it is 13%, what happens? The loan will go up, but the deposit goes down. Those who are working in banks, or those who have ever taken loans, or those who are keen with the news, the business news. Today, as we speak, the base lending rate is 13%, I believe, or 13.5. It is the average. But now, banks will now come here. And when they're giving interest on loans, they charge maybe something like 20, they give something on top. The difference between this and this is the premium. 7, 13, and 20. That 7 is the premium. It is the profit they are going to get as a result of risk they are taking to give you the loan. This is the return they are getting as a result of the risk for giving you a loan. But if they are going to take or accept deposit, they normally give maybe 8% or 10%, less than the mean, which is the base lending rate. So therefore here, base lending rate acts as a risk-free. Why? It has a lower return. You can go and borrow, and you are sure that you can still get this money. Because even if I go now and take that money from CBK at 13%, I give somebody at 13%. The only thing that I've done is that I've wasted time, but my money, I'm sure of this return 13%, because it is the minimum that you can be able to give. The same with this. So here, act as our benchmark, right? Now, the premium for giving you or for investing somewhere that is risky is now the one on top. So therefore, we are seeing that kumbe, the rate of return is normally made up of two factors, one that is risky and the other one that is risk-free. When people are giving loans, they consider two factors, the risk-free interest rate and the risky part. Topista, are we okay? Now,
Yeah.
these loans are risky, and that is why a good investor needs to now look at the specific risk on that investment or project. They are just the specific risk. If the risk on that investment is inflation, you adjust the inflation risk. If it is caused by the exchange rate, changes in exchange rate, you adjust with that. So that is why we are saying that, okay, you have given us the discount rate, but can we look at the specific risk on that project so that we adjust it? It is a risk-adjusted discount rate. In summary, the formula for us to get a good rate or interest rate or rate of return after adjusting, we are saying that now the risk-adjusted discount rate should be the minimum, which is risk-free, which we are sure of, plus the minimum, which is risk-free, plus KO minus RF, risk index. What are we saying? This is the same as cost. Cost of capital is called KO. So this cost is like 15%, and the risk-free is 10%. Now, the risk-free is 10%. And let's say that the risk index in that business is something like, maybe the risk index is 6 or 5, or even 2 or 0.1. So what we are saying is that this is what is expected that is risk-free that you should get as a business person. The risky element between this and 15, like the way we say, 15 niko hapa, hii ni 10, 15 niko hapa. This element that is risky, this part is what we want to get. So how do you get this? Take 15 minus 10. This one is 5. That is what we call the premium. It is the one that you multiply with the risk index. This is the risk, or you just call it risk. You multiply that premium with the risk. You don't include the one that is risk-free. So that is why this formula looks like that. That first, as an investor, you need to be sure and pocket the return that is risk-free. I've pocketed this. Each element that is risky is the total risk, total cost of capital in the market, minus the risk-free rate. I'll get the premium or the portion that is risky. I multiply that risky rate of return with the risk. So I've adjusted it. That is the formula, and that is how we get those ones that you are being told that the cost of capital was 10%. The rate of return was 5%. How did they get it? This one, if it is adjusted. If it is not adjusted, then they don't go to that extent. We shall be able to see. So you say where, I hope that you've written now this one you can write. Then you say where KO is equal to cost of capital or firm's cost of capital before adjustment, right? That is the normal cost of capital without adjustments. Then we have RF, referring to a risk-free rate of return. Risk-free rate of return. Tuko pamoja hadi hapo? I need to see your comment. Are we together up there? Are we together? Waziri? Waziri ameenda kuomba. Let me check if she's around. Ameanza maombi. Nimeshangaa. Ningekuwa amejibu. So, waziri ameanza maombi. So, tumpe time kidogo like 5 minutes. Akirudi atuambie. Which kind of risk do you think we are exposed to? So we are written RAD is equal to RF plus into KO minus RF risk index. And we say that the KO is the cost of capital. RF is the risk-free rate of return. We say that CAPM is the same as RAD. And the formula for CAPM, we have said that CAPM is equal to RF plus the bracket ERM minus RF beta factor. So we are saying that beta factor is a measure of systematic risk. That is the risk that cuts across all industry. So let's say that banking is an industry. This is not a risk that you cannot diversify. So when we talk about all industries, it means that banking institution can be affected, education institution can be affected, because all industries, not just one industry. So you cannot diversify it by moving from investment in banking to tourism to education. No, that one does not help, because ukienda hapo utaipata, ukienda place zingine, because all industries are affected, and that is why we call it systematic. It is systematic. Somebody say that systematic, it is the same. Like challenges that people face in their life. There are some that are systematic. They are all over. We normally say that it rains everywhere. It's all over. So, I was asking that which kind of risk do you think we are exposed to as education institution? Waziri said something. Let me see what Waziri is saying. According to me, Kenya Power is not even risk. Mara stima hakuna. Okay, that is it cutting across all the industries or maybe the education institution? Or upper NTC, financial losses. Oh, you are saying upper NTC. That is the risk that we are facing, financial losses. But the risk that we are facing is okay, common education. Okay, I can say that the risk that we are facing is the quality of education. There is less value given.
I was typing exactly that, quality of education. I remembered my times in KU.
Yes, people have really undervalued education. It does not matter. You know, there's a student that was part of my class last semester. So after kumaliza exam, this year alikuja kwa ofisi ananiambia nataka kazi ya audit. Nikaanza kuminterview. Alikuwa class last semester, lakini amerudi. Na wakati alikuwa class, alikuwa ananiambia anajisomea videos, ana watch, hataki kuattend class. Ati mwalimu, me I only need videos. Watch, then I'll just do my self studies. I don't want to join live class. Now, early this year, the second week of January, alikuja kwa ofisi anataka job internship. Nikamuuliza simple questions that I personally taught in audit intermediate. Ananiambia ajui, hajasikia kitu kama hiyo. Nikamuuliza, but I gave you my videos and they were complete and I taught you and you passed. Kaniambia, I only watched what could make me pass. I only watched what could make me pass. So education industry is being affected by the quality of education. There are a lot of reluctance. People are so reluctant. And so people don't see the value. And you see, if they don't see the value of something, they don't buy it. That's why we have so few students, very few students in the class, because they don't see the importance of coming to class. They only see that it is the paper that is important. It is not the content. Not the content. Of course, sikumchukua na ni mwanafunzi wangu, na kwa hivyo hakurudi this semester, hajaingia class. Sikumchukua, nilikata, nilimwambia I can't take somebody who is half-baked. Hata kama ulipita, haujaiva bado. Haujaiva. You can't come to my class. You don't know what letter of representation is. You don't know what engagement letter is. And that's what you're going to do when you come to work with me. That is engagement letter that you're going to draft. And I taught you. Na unaniambia ulisoma tu kwa ajili ya kupita mtihani. So every industry has got some risk, but there are risks that cuts across, like the risk that relates to, and then I can say WhatsApp here imetuharibia. People are able to share materials on WhatsApp, and for that matter, people don't even know which one is quality, which one is not quality. Mtu anachukua tu as long as amepata. So I was saying that the one that cuts across all industries, like throughout the country, iko kila mahali, is called beta factor. Beta. That beta is a risk that cuts across, like the political risk, inflation, taxation. Taxation could be taxes, depends on which tax. Housing levy is now cutting across. Taxation depends, like we have turnover tax that can affect some industries and not the other ones. VAT can affect others, but not all of them. So that is an example. So let's take an example here. I want you to look at the cost of capital given the following information. Say that given the following information, given the following information, where risk-free rate is 10%, cost of capital is 12%. Cost of capital is 12%. Risk index is 2.5. Risk index is 2.5. Can you calculate for me a risk adjusted rate of return? Determine RAD. Can you get me RAD? I have a rate Is there anything that is cost of capital? Yeah. The KO. This one refers to KO, cost of capital. Can you calculate for me the adjusted rate of return? The return that has got the risk element. Tell me how much it is. %15%. Another person. I want like all of you to try. Kila mtu ajaribu. So 15% you got like this. You came here and say that the RAD is equal to RA plus KO, which is the cost of capital, minus RF risk index. Risk index. Risk index. Then now you come and replace it. 10 plus 12 minus 10 into 2.5. Then you come here, 10 plus, this is 2 times 2.5 is 5. So you have 15. That is the rate of return after adjusting risk. So the original rate of return before we took care of the risk was 12%. When we realized that there's some risk, tukaweka hiyo risk kwa hii return. Ni kama biashara. When you know that there is a cost, you add the cost on top of the profit, so that you say, now the price of buy goods are the cost of buying it, transport cost or whatever store. So you add all of them there, and then you get the price. The same thing. In this return, we expect some risk. So even though the expected return is 10%, we add the risk element, which makes it now 15%. And the risk element is only on the risky area, which we call premium. This part we call it premium. Premium. So we call it premium. Risk premium. It is called risk premium. The difference between this and this risk premium. Even this one, the difference between this and this risk premium, it is the return that comes as a result of the risk that you are taking. That return is associated with the risk premium. Now, I want us now to look at this question. Different projects here. Say illustration 2. So you have seen how you can adjust discount rate to have some risk element on it. I want you now to look at this illustration. Consider the following cash flow. Illustration 2. Consider the following information. And then we have year. Then we have cash flow. So we have projects cash flow. Those are cash flow from projects. Projects cash flows. So we have year 1, year 0, 2, 3, and then 4. So we have the first one is 15. We have project give me how 0. So we have project Y. Sorry, X, Y, Z. In year 0, it is 15,000. And then we have 11,000. Then we have 19,000. And then we have 6,000. Then I have 4,000. Can somebody calculate for me NPV of these projects using the risk adjusted discount rate calculated above? Required calculate NPV of each project using the risk adjusted rate RAD calculated the RAD calculated in illustration 1 above. So that is a question. I want you to try, and then you let me know where you have reached. Try the first one, X. Determine NPV of each project using the RAT calculated in illustration 1. Illustration 1. Illustration 1. Above. You know it, 15%, right? So that means that if you're given those information, you can be able to change it to RAD, and then you calculate NPV using the RAD, using the risk-adjusted discount rate. So get me the one for X, Y, and Z. Jaribu ya kwanza tuone. Nataka nione wenye wanapata. Project X is having regular cash flows. The cash flows are regular. You do them separately. These are projects. You do them separately. So these are regular. So you say NPV is equal to cash flow times PV for 15%. How many years? 4 years. Minus IO. You know the IO you are given. Okay? So the IO that you were given was IO is 15. This is the IO, initial outlay. This is the cost of investment. The one is year zero. Year zero. So we have here our cash flow, which is now 6,000 times PV per. What did you get? When you use this formula, minus 15,000, what do you get? 2.8550. So we are having 6,000 times 2.8550 minus 15,000. And I hope that you're going to get your answer, which is 2130. That's the first one. And I hope everyone has seen that. Now let's get to project Y. NPV for project Y. NPV for project Y. We have year 0, 1, 2, 3, 4. We have cash flows. So we have here 15,000. Just 1 minute. Can we proceed? So we were doing the one for project Y. Sorry, project Y. And in project Y, we have them here. So the cash flows are 6,000. Sorry, project Y we have, that is project X. Y we have initial outlay is 11, and then we have 6,000. So this one is outlay. Then we have 6,000. Then we have 4,000. Then we have 5,000. Then we have 2,000. Right? So our discounting factor here, can somebody get us discounting factor at 15%? What is it? Discounting factor at 15%? Discounting factor at 15%? What do you get? Let's move very fast because we have one more example before we close today's class. So we have this and another one. So you have there 0 point. This is 1. We have 0 0.8, 696, 0 0.7, 561, 0 0.5, no 6, 575, 0 0.5, 718. Okay. So what is the present NPV? This is NPV because you're going to subtract direct. You're going to subtract direct, so it is NPV. So it is 11, 11. Can we calculate this? Then we get our NPV here. I hope that the other team members are also confirming the figures to make sure that they are correct. Confirm to make sure that they are correct. Topista and Ruth have given me the answers. Kindly confirm that they're okay. So the first one is 52, 17.6. 52, 17.6. The second one is 30, 24. 0.4. 30, 24.4. Then we have 32, 87.5. Then we have 11.6. So what is the total? The total becomes 16. Is that what we're getting? 1673. Point 1. Is it correct? Very correct. Thank you. So let's do the last one. You have the figures, eh? Z. So for Z, we have let me see the figures that we are having. We are having 4,000. The cash outflows or cash inflows, we have 4,000 in year 1. Year 2, we are having 6,000. Then we have 8,000. Then we have 12,000. Okay. Now the rest we can use the same one here. Discounting factors remain the same. The only thing that we're now changing is the outlay. Calculate for me this one again. So you have there 19,000 cash outlay. Then you can do the rest. Calculate that. The figures are 34. Okay, 3478.4. Then we have 45, 36.6. Then we have 520, 5260.0. Then we have 68, 61.6. What do you get? You're getting 1136.1. 1136.1. 0.6. 1136.6. Is that correct? Now let's look at illustration, another illustration, the last one. Then we are done with that subtopic. Given the following or given the below, I hope that this one is okay, so I can run. Given the below, project X, given the below, project X, Y, Z, the same projects that we had seen. Given the below, project X, Y, Z that you are given, these are the projects that we have already, and you know their cash flows, right? So from what we have, those cash flows that you've been having, we are now given additional information that given this information about those projects, risk index is now given. And the risk index in project 1, the first project is 8, this one is 1.0, then we have 0.6. Given that information, determine the risk adjusted discount rate for each project. Determine the risk adjusted rate for each project. No, sorry. Additional information. Given the below, this one, then they are giving additional information here that RF is 10%. RF is 10%. ERM is 12%. Then we have beta is 2.5. Required. Determine the risk adjusted discount rate for each project. Determine the risk adjusted discount rate for each project. Determine the risk adjusted discount rate for each project. Determine the risk adjusted discount rate for each project. Determine the risk adjusted discount rate for each project. Now, how do we go about this? Who can tell me the first step? Given that you're using the other cash flows that you're having, the other cash flows that you're having for project X, Y, Z, cash flows only. You've been given those cash flows and you are also given the risk index for those projects. They have also given the risk-free rate in relation to this, ERM in relation to this, and beta in relation to this. Then they are telling you, get us the risk adjusted rate for each project. So get us the RAD for X, Y, and Z, given these ones. Given this, can you get risk adjusted discount rate? Where do we start from? Mepewa risk adjusted risk index, and they have also given you risk-free rate, ERM, and beta. Even though you know that you have cash flow somewhere, they have not told you to start using the cash flow. First, they are telling you, can you get us the rate that we shall use to discount those cash flows? That rate should be RAD, should be adjusted, risk adjusted. How do we start? Who can tell me the first step? You can speak, I believe. Calculate KS. That is the cost of capital. Now, KS is normally cost of equity, ordinary equity. So, can you reframe it again, Henry? What are you supposed to do? You're almost there. With this information that you're given, here chini hapa, RF, ERM, and beta, what can you get with it? Determine the premium, KAPM, calculate. Yes, Mary, you are there. You can get KAPM, cost of capital, or cost of capital using KAPM. You can get cost of capital using KAPM. So we start with that. The cost of capital using KAPM is KO. So you say KAPM, cost of capital, is given as RF plus, in bracket, ERM minus RF risk index, or beta, still beta. That is the formula, right? That is what we learned. So we are saying that even though this examiner wants us to start with getting risk-adjusted rate, our risk-adjusted rate of return, which is RAD, is equal to RF plus, in bracket, KO minus RF into risk index. That is how you can get the risk-adjusted rate of return which they want. But we don't have KO. At least risk index we have for each item, but we don't have KO. The only way we can get KO is when we apply KAPM. The cost of capital we can get when we apply KAPM, and we have been given information here which can help us to get it. So we come and use this formula, and we say now KO is equal to 10% plus, in bracket, 12 minus 10 into 2.5. So what is it? You are getting here 15%. That is the KO. KO is 15%. Are we together there? Umeambiwa utafute hii, lakini huwezi tafuta hii kwa sababu kuna kitu iko missing hapa. And this thing you can get it. The rest at least you have. This one you can get it when you calculate or solve this. So you can use this formula, use this information to get your KO. Then now KO, you can now proceed and get the index for each. You can get RAD for each. Are we together up to there? That is what Mary was trying to say. And I know that is what Henry also tried to say, that you can get KO, but he uses the word KS. Tuko pamoja hadi hapo? Haraka tuendelee. We need to go and sleep.
Mwalimu, niko na swali mpaka hapo iko sawa, lakini nashangaa hiyo KAPM alafu umeweka cost of capital equals to, sasa imetoka wapi tena?
KAPM is a model. It is a model that is used to calculate cost of capital. So we are saying that getting cost of capital,
But you gave us the formula. You gave us the formula ya KAPM. Hiyo ingine haikuwa hiyo formula.
What is the formula of KAPM? Check your notes.
Equals to risk free plus ERM minus RF into bracket beta factor.
That is a KAPM. KAPM is a model. So it is a model of getting what?
The capital, KAPM is the capital asset pricing model.
Yes. So it is supposed to be used.
In other words, KAPM means it is the cost of capital.
The price of capital is the same as the cost of capital.
Okay, that's what I wanted to find out. So, thanks.
So KAPM KO is the same as the KAPM cost of capital or price of capital. For example, I say that when ukienda kununua nguo, the price of that cloth is the same as the cost of that cloth. It only depends who is selling. The seller call it price, the buyer call it cost. It is the same thing.
Okay, thanks.
Now, from here, you can now replace this one for a respective project. Now that you know that KO is 15, we can now get it. This one is done. This information was only to help you get KO. Now that we know KO is 15, we can get our KO for each project. So you can say, now our RAD, which they wanted, RAD for X is equal to RF plus 15, in fact, RS plus KO minus RF risk index. So that we have, for X, we have 10%. We have 10 plus bracket 15 minus 10. Risk index is 1.8. That is for X. Risk index varies. So use risk index for each separately. Kipewa separately, tumia separately. So what is the answer? Then we have Y. Y also has a different rank because of the variation in risk index. So we have 10 plus in bracket 15 minus 10. What varies me? 1. What is the answer? Then now we have the last one. Get me the answers. Now vile ni rahisi. Kisha elewa. Then it is okay. Z is equal to 10 plus in bracket 15 minus 10 into 0.6. What are the answers? Then we look at the last Roman 2. That is Roman 1 was determine the risk adjusted discount rate for each project, which we have done. Roman 2 now is to calculate the NPV for each. Let me the RAD for each. The first one RAD ni ngapi? The second, third. Hivyo. Okay, so somebody got 19 here, and then 15, and then 13. That was what the examiner wanted. So let's now get our NPV for each project using the risk-adjusted rate. These are now risk-adjusted rates. Unfortunately, for Y, the risk-adjusted rate for Y is the same as the one that we got earlier in the previous example. Now, because we're going to use the same cash flows, we know that our NPV for Y will still be the same because the rate is the same, the cash flows are the same. We are just going to repeat what we have done. But let's see for the others. Can we now get NPV for project X. NPV for project X. So project X, we have a very constant cash flow. And we know that if the cash flows NPV for X is equal to the cash flow times regular, which is PV for. And there are how many years? The rate is now different. It's now 90%. Right? For X, using the same cash flows, the rates have changed. So it is 19%, but 4 years minus IO. So we are saying that the cash flow was 6,000 using the same cash flows. Now get me this. What is PV per here? The rate minus 15,000 was the IO. What is the rate here? You've given me 2.6389. Clear? Yeah. What is the answer? We are almost done. In the next less than 10 minutes, we should be done. So what is the answer? $833.4. Someone is getting 831. Is it 833 or 831? The correct figure is 831.6. Okay, so let's go to project Y. So NPV for Y. NPV for Y, the same as the previous one. Was it adjusted? In Y, RAD is the same as the cost of capital, right? The cost of capital that we used previously was how much? What was the cost of capital that was previously used? 15% still. The same as cost of cost of capital of, or which is 15%, where NPV was, what did we get as NPV? Nasema hakuna haja turudie because tulikuwa tumefanya hii in the previous example where the cost of capital was the same as 15%, and that is the same as RAD here. We are gotten the NPV. So badala ya kurudia, unasema tu that NPV for Y, RAD is the same as the cost of capital, where our previous NPV, where previously calculated NPV was calculated NPV was how many percent? Calculated NPV was 73.1. So which is the same thing. So hakuna haja kurudia, sio? It is the same as the cost of capital that we have used. previously, and the NPV that was previously calculated, we know. So unaandika tu hivyo, and then we are okay. So for Z, NPV for Z, that is for Y. NPV for Z. You know it. We have to get the project Z. Then we have to say, it is the last one still. The year 0, 1. But NPV for Z, we just say year 0, 1. Then we have cash flow. Cash flow is how much? 19. We have 19,000. Still, that is what we are having. 4,682, okay? 4,006. Then we have 8. We have 12. Our discounting factor now is at 13%. That is a risk adjusted rate that we are told to use. So get me the risk adjusted rate here, and then we get our NPV. Very simple. So this one I know is 19. Get me this one's 13% for the 4 years. Always advise the client when you get your NPV, always advise the client. Always give advice. So get with that. Thank you. So we have 08850. Then we have a 078. Ruth has given me. I like Ruth. She's very fast. Though hapendangi kuongea, lakini she's very fast in giving answers. So we have 6931. Anaongea na kalamu peke yake. 6133. Okay, so get the total here. Ruth has given them present value. Year 1 is 30. 35, 40, 46, 98. Point 6, 55, 44. 0.8, 73, 59, 0.6. Then you are saying that our NPV is 2143. 2143. Was it difficult? Always advise a client. Advice is accept because the NPV is positive. So accept the project. Anytime when you're doing NPV, end up by advising. This is normally 1 mark. And it can take you far. Remember, if you had 47% or 49%, this one alone will make you have 1 extra mark, and then you pass your exams. So I hope that that is okay. We still have some areas that we shall look at. We need 3 to 4 more classes, unfortunately, before we are done. And that must be done next week. Next week, we must finish, even if you're doing a makeup. Unless you want us to take a break now for some 20 minutes and then proceed. Ndio next week tufanye 3, but kama sio hivyo, then we have to do extra class next week. Mko sawa? Are we okay? We can take a break or we stop. We take a break 20 minutes, then we come back, or we stop. Tuendelee class in our next lesson. Niko kwa giza. Sorry. Okay, so somebody is saying that we proceed in the next class. Fine. Let's prepare for tomorrow job. Yeah, fine. Let's talk, please. Fine. Yes, sawa. So next week, kuanzia kesho, we need 4 lessons kumalize topic 1. By the end of February, we should be done with topic 1 and 2. Then we are set. Topic 1 and 2, then we are set. The rest are easy. The rest we can do within March and first week of April, and then we're done. See you. Have a good night. Kama kuna swali. Ramadan is coming. Okay, so somebody is saying something. Kuna mtu amesema kitu sijaelewa. Thank you. Starting 11th March too. I shall be exhausted. So let's see next week if we can be able to finish. So the areas tumebaki nazo ni kidogo sana.